In 1923, something happened in Germany that most people today cannot even imagine. The currency didn't just lose value. It didn't just decline. It evaporated. A single gold coin that you could hold in your hand became worth more than a wheelbarrow full of paper marks. People who had saved their entire lives, who had done everything society told them to do, who had been prudent and responsible, watched their life savings become worthless in a matter of months. Professors couldn't afford bread. Doctors burned cash in their fireplaces because the paper had more value as fuel than as money. An entire social class, the backbone of one of the most advanced economies in Europe, was wiped out. Not because they were reckless, not because they made bad decisions, but because they trusted paper when they should have trusted gold. Now, I'm not bringing up a 100-year-old crisis just to tell you a history lesson. I'm bringing it up because what happened in 1923 didn't stay in 1923. The pattern repeated in Hungary in the 40s. It repeated in Argentina multiple times. It repeated in Zimbabwe in the 2000s. It repeated in Venezuela just a few years ago. And every single time, without exception, the people who held gold walked through the fire. The people who held paper got burned. Right now, in 2025, we are watching the earliest signs of that same pattern forming again. Not in some distant economy, not in some small nation that mismanaged its finances. Here, in the United States, in the world's reserve currency. And if you own gold and silver, or if you've been thinking about it, what I'm about to show you will change how you see everything that's happening in these markets right now. The last month has been brutal. Gold crashed from $5,600 down to $4,000. Silver got cut nearly in half, dropping from over $120 to the low 60s. People panicked. I saw it in my comments. I saw it in my messages. Long-time holders were questioning everything. New buyers felt like they'd been led into a trap. The fear was real. The pain was real. And I completely understand why people felt that way, because watching your portfolio drop 30, 40, 50% in a matter of weeks is not easy. It tests you in ways that nothing else does. But here's what almost nobody is talking about. That kind of violent volatility, those gut-wrenching swings, those moments where it feels like the bottom is falling out. They are not abnormal during a currency crisis. They're not a sign that the thesis is broken. They are actually confirmation that we are moving deeper into the exact pattern that has played out over and over throughout monetary history. The crashes during Weimar weren't smooth declines. They were violent. 30% drops followed by 100% rallies, followed by another crash, followed by an even bigger rally. The volatility was insane. And the people who couldn't handle it, who sold during those drawdowns, they missed the move from 100 marks per ounce of gold to 10 billion marks per ounce. Let me say that again because I want you to really absorb this. 10 billion marks for 1 ounce of gold. That's not a typo. That's not an exaggeration. That is what happens when a currency loses the confidence of the people who use it. And the path from 100 to 10 billion was not a straight line. It was chaos. It was volatility that shook out everyone who wasn't absolutely convicted in what they held. So when I look at what just happened to gold and silver over the last month, I don't see a market that's broken. I see a market that's behaving exactly like it should during the early stages of a major monetary shift. I see weak hands getting flushed out. I see leveraged speculators getting liquidated. I see paper contracts being sold in mass while physical metal gets harder and harder to find. And I see a setup that, based on every piece of data I track, is coiling for a move that's going to make the last rally look small. Now let me show you why I believe that. And I'm not talking about hope. I'm not talking about speculation. I'm talking about data that you can verify yourself, data that tells a very clear story if you know how to read it. Let's start with what's happening in the silver market right now, because this is where the signal is loudest. The open interest on COMEX silver futures has collapsed to levels we have not seen in over 20 years. Open interest is the number of active futures contracts in the market. It represents the paper side of silver trading. When open interest is high, it means there's a lot of speculative activity, a lot of leverage, a lot of traders playing the swings. When open interest collapses, it means all of those players are gone. They've been stopped out, they've been margin called, they've liquidated and walked away. Right now, open interest is sitting at approximately 112,000 contracts. That is the lowest reading in more than 2 decades. Think about what that means. We just had one of the most dramatic price moves in silver's history. We went from $30 to $121 in a matter of months, then crashed back to the 60s. And through all of that, the speculative interest has been completely flushed out of the market. The tourists are gone. The momentum chasers are gone. The leveraged funds that were riding the wave, they got washed out on the way down. What's left is a market with almost no sellers. Because here's the thing about open interest. When it gets this low, it means there's nobody left to panic. The people who were going to sell have already sold. The contracts that were going to be liquidated have already been liquidated. The market has been wrung out completely. And when a market is this clean, this flushed of weak hands, the next move tends to be explosive. Because when buyers start coming back into a market that has no sellers, Price doesn't grind higher. It gaps higher. It moves fast and it moves far. But there's another piece of data that makes this even more significant. Despite silver crashing 50% from its highs, the physical market is still in backwardation. For those who don't follow the technical side of commodities, backwardation is when the spot price, the price for immediate delivery, is higher than the futures price, the price for delivery months down the road. In a normal, healthy market, futures prices are higher than spot because there's a cost to store and finance the metal over time. That's called contango. Backwardation is the opposite. It's abnormal. It only happens when there is a severe shortage of physical metal available for delivery right now. So let me paint the picture clearly. Silver's price got cut in half. The paper market got absolutely demolished. Open interest collapsed to 20-year lows. And yet the physical market is still so tight that people are willing to pay more for silver today than for silver delivered 3 months from now. That tells you everything you need to know about what actually happened during this crash. It wasn't physical silver being dumped onto the market. It was paper contracts being sold by traders who got blown out on margin. The paper sold. The physical tightened. And that divergence is one of the most bullish signals a commodity market can produce. Now let's talk about what happened last week, because this is where it gets even more interesting. The bullion banks, the big players who sell options contracts and manage huge positions on the COMEX, they had a strong incentive to push prices down going into the end of March. There were massive amounts of call options that were set to expire. Call options give the buyer the right to purchase metal at a certain price. If the price stays below that level, those options expire worthless and the seller keeps the premium. If the price goes above that level, the seller has to deliver or cover, and that gets expensive fast. So what do the banks do? They hammer the price. They sell futures contracts, they create downward pressure, they do everything they can to make sure the price stays below the strike prices on those calls so the options expire worthless. It's a game that's been played for decades. It's not a conspiracy theory, it's market mechanics. And it works because most option buyers don't have the capital or the conviction to withstand the pressure. They sell. The options expire worthless. The banks pocket the premium, and the game resets. But here's what changes now. The April delivery period starts this week. And there are still over 63,000 gold contracts open that need to be resolved. Those contracts represent a massive amount of metal. And when the options game ends and the delivery game begins, the dynamic shifts entirely, because standing for delivery means someone wants the actual gold, not the paper, not the cash settlement, the metal. And if even a small percentage of those contracts demand physical delivery, the COMEX has to produce it. And producing gold that may not be sitting in the vault in sufficient quantities is a very different challenge than selling an unlimited number of paper contracts. This is the pressure point. This is where the paper market meets physical reality. And based on everything I'm seeing in the data, that collision is coming soon. Now let's zoom out and talk about the macro picture, because this is where the Weimar comparison becomes more than just a historical parallel. It becomes a roadmap. When the German currency collapsed, it wasn't random. It wasn't bad luck. It was the inevitable result of a government printing money to pay for debts it couldn't afford. Germany had just lost World War I. They had massive reparations to pay. They had a destroyed economy to rebuild, and instead of facing the reality of their situation, they printed. They printed to pay the debts. They printed to fund the government. They printed to keep the system running, and for a while it worked. For a few years, people still accepted the marks, still used them, still believed they had value, but belief is a fragile thing, and once it cracks, it shatters fast. By 1923, the printing had gone on so long, and the quantity of marks had expanded so much that people stopped believing the paper had value. And when that belief died, the currency died with it. Gold, which had been sitting quietly at 100 marks per ounce for years, started moving. Slowly at first, then faster, then vertically. By the end, it was 10 billion marks per ounce. Not because gold changed. Gold is the same metal it was in 1913. But because the marks became worthless. Now look at what's happening in the United States today. $39 trillion in debt. $1 trillion added every 100 days. Billions per week being spent on military operations overseas. A Federal Reserve that has spent the last 15 years expanding the money supply at a rate that would have been unthinkable to previous generations. And the entire system held together by one thing: the global reserve status of the dollar, the fact that the world needs dollars to buy oil, to settle trade, to hold as reserves. That system, the petrodollar system, has been the foundation of American financial dominance for over 50 years, and right now that system is being directly attacked. Iran is not just threatening to disrupt oil flows through the Strait of Hormuz. They are demanding that any ship that wants safe passage pay for their oil in yuan, not dollars. Yuan. They have turned the strait into a toll booth, and the price of passage is abandoning the dollar. Every tanker that pays in yuan instead of dollars is a crack in the foundation. Every crack weakens the structure. And if this continues, If more and more of the global oil trade shifts away from the dollar, the consequences are staggering. There are trillions of dollars held overseas right now, specifically because the world needs dollars to function in the global economy. Middle Eastern sovereign wealth funds hold hundreds of billions in US equities. Asian central banks hold trillions in US treasuries. If the petrodollar system breaks down, if those countries no longer need to hold dollars to buy oil, what happens to all those trillions? They come home, or they get shifted into other currencies, other assets. And when trillions of dollars start moving out of US markets, the pressure on the dollar, on bonds, on stocks, is unlike anything the modern market has ever experienced. And here's the part that connects directly to gold and silver. When the dollar weakens, when confidence in the currency erodes, when the global reserve system starts to crack, gold goes up. Not a little, a lot, because gold is the alternative. It's the asset that has no counterparty risk, no government backing it, no central bank printing it. It just is. And for 5,000 years, every time a currency has failed, gold has been the refuge. We are not at Weimar levels yet. I'm not saying the dollar is going to collapse tomorrow, but I am saying the pattern is forming. The debt is there. The printing is there. The war spending is there. The de-dollarization is happening in real time. And the same forces that produced the Weimar collapse are present in the US economy today. Different scale, different timeline. But the ingredients are the same, and that's why the recent crash in gold and silver is not the end of the story. It's the volatility that happens in the middle of a much larger move. If you go back and study the Weimar charts, the path from 100 to 10 billion was not smooth. There were massive drawdowns, 30% crashes, moments where it looked like the rally was over. And every single one of those crashes was a buying opportunity in hindsight, because the ultimate direction never changed. The currency kept losing value, and gold kept going higher. That's where we are right now. We just had our 30% crash, the weak hands sold, the leveraged players got flushed, the paper market got cleaned out, and now the market is reset, the sellers are gone, the physical shortage is real, the macro forces are accelerating, and the next leg up is forming. Let me give you a framework for how to think about this because I think it helps to see the structure. Every major currency crisis goes through phases. Phase 1 is stability. Everything looks fine. The currency works, people trust it. Gold barely moves. Phase 2 is the awakening. Cracks start to show. Inflation picks up, gold starts moving, but most people don't notice. Phase 3 is acceleration. The problems become obvious. Confidence starts to erode. Gold moves faster. More people start paying attention. And phase 4 is the vertical move. Confidence collapses. The currency dies. Gold goes parabolic. Weimar went through all 4 phases. So did every other hyperinflation in history. And the US dollar chart over the last 40 years shows phase 1 and phase 2 clearly complete. Gold sat at $300 for decades. That was phase 1. Then it started moving, slowly at first, up to 1,000, then 2,000. Then it exploded from 2,000 to 5,600 in just a few years. That's phase 3, the acceleration phase. And we are still in it. The crash from 5,600 to 4,000 doesn't change that. It's volatility within phase 3. It's the same kind of violent swing that happened in every other currency crisis during the acceleration phase. And what comes after phase 3 is phase 4, the vertical move, the move where gold doesn't go up 20% or 50%, it goes up multiples, it reprices against a currency that is losing global trust. I don't know when phase 4 starts. It could be years away. It could be closer than anyone thinks. But the pattern says it's coming. And the people who own gold and silver when it arrives will experience wealth preservation on a scale that most people can't imagine. Silver in this environment is even more compelling because silver has all the monetary properties of gold, the same 5,000-year history as money, the same lack of counterparty risk, the same protection against currency debasement, but it also has industrial demand that gold doesn't have. Solar panels, electric vehicles, electronics, grid infrastructure, all of it requires silver, and the supply is not keeping up with demand. We are mining less silver today than we were 10 years ago, while demand is accelerating. So you have a monetary crisis building that benefits all hard assets. You have an industrial shortage that's getting worse every year. And you have a paper market that just got completely flushed out to the lowest levels in 2 decades. The setup is extraordinary. And the crash we just lived through, as painful as it was, cleaned out all the weak hands and set the stage for what comes next. I want to be clear about something. I'm not telling you this to create fear. I'm telling you this because the data is screaming and most people aren't listening. The COMEX open interest is at 20-year lows. That's a fact. Backwardation is persisting despite a 50% price crash. That's a fact. Iran is forcing yuan payments for oil passage through Hormuz. That's happening right now. The US has 39 trillion in debt and is adding a trillion every 100 days. That's public data. And the gold chart over the last 40 years looks nearly identical to the early stages of the Weimar gold chart. You can verify that yourself. None of this is speculation. It's pattern recognition based on historical precedent and current data. And if you own gold and silver, you are positioned on the right side of that pattern. The crashes will keep coming. The volatility will continue. That's part of the process. But through all of it, the direction is clear. Up. Because the forces driving gold higher, currency debasement, government debt, money printing, loss of reserve currency status, those forces are not going away. They're accelerating. 1923 is not repeating exactly, but the pattern is. And this moment right now, after a brutal crash, with sentiment at lows, with weak hands flushed out, with the paper market cleaned out, and with the macro forces still building, this is the calm before the storm. The data supports it. History supports it. And if you have the conviction to hold through the volatility, what comes next is going to prove that patience, right? Stay focused. Stay convicted. And understand that what you're holding is not just a trade. It's 5,000 years of monetary history telling you that when currencies fail, gold survives. That pattern has never been broken, and it's not going to break now.